Welcome to this PIIE event on the IMF Fiscal Monitor, which has just been released. We will be hearing about Chapter 2, which covers the topic of strengthening the credibility of public finances. This is, of course, a very timely topic, given the sizable increases in government debt that so many countries have experienced over the last 18 months. These increases in government debt stem largely from the spending countries did to contain the virus and to limit hardship and to limit economic scarring in the face of enormous job loss. And most people would agree that this spending was very important and valuable. And countries have been able to do it without raising their interest burden, given the very low level of interest rates that many countries are facing. But nonetheless, it leaves countries with less fiscal space to respond to ongoing pandemic-related needs. It leaves them with less space to respond to future shocks, and it might put some countries at risk of fiscal crises if market confidence erodes. So given those challenges and risks associated with these higher levels of debt, this chapter addresses the important issue of how countries can buy some space and time when it comes to fiscal space, and they can reduce the risk of crisis by making a credible commitment to fiscal sustainability. So with us today are Raphael Espinoza and Paolo Mauro from the IMF. Raphael is a deputy division chief in the IMF's Fiscal Affairs Department. He was previously an assistant professor in economics at University College London, where he was also the director for the Center for Studies of Emerging Economies. And he has published widely on fiscal policy, monetary policy, and financial stability. Paolo is deputy director in the IMF's Fiscal Affairs Department. Paolo is also a very highly respected economist. He's published on debt issues and other important topics. Paolo, at earlier stages of his career, has held a variety of jobs within the IMF, and he also was here at Peterson as a senior fellow for a few years in the mid-2010s. So welcome to our speakers. And with this, I'm going to hand things over to Raphael, who's going to do a presentation. After Raphael presents, we're going to take questions through the Zoom Q&A feature. And you should think about your questions as Raphael is presenting. If you want to put your questions in the Q&A box while he's presenting, you're welcome to do so. And when he's done, I will then start asking them your questions. So, Raphael, it's over to you.
Thank you very much, Karen, for the introduction. I'm sharing my slides. I hope you see them well. So the focus of our report, as you were mentioning, Karen, is on strengthening the credibility of public finances. This was published only about a week ago for the IMF annual meetings. And the reason why we chose this topic is because with countries facing some difficult fiscal policy trade-offs, we thought that strengthening credibility can help countries buy some precious time. But the point of the presentation is to explain what I mean. So fiscal policy played a very supportive role, as we know, during the pandemic, but the crisis is not over. For many countries still struggling to contain the pandemic or just coming out of it, fiscal support to protect households, firms, and support the recovery will remain essential. At the same time, fiscal buffers have been eroded. The chart on the right-hand side shows the effect of the pandemic on public debt for the different country groups. And you can see the debt has jumped more for advanced economies. But that doesn't mean that the emerging markets or the low-income countries suffered less during the pandemic, or that they did more to preserve fiscal buffers. On the contrary, the divergence we see in this chart reflects the limited capacity that many emerging markets and most low-income countries had to increase their borrowing to address the pandemic. So these countries clearly already faced tight budget constraints, and the challenge they are facing now with even more debt are not going to get easier. So the objective of the chapter is to help us understand how countries can strengthen the credibility of their public finances at the lowest cost for growth, because we still need to support the recovery. And this is done by what we will talk about strengthening fiscal frameworks. So let me define a bit what these fiscal frameworks are. These are the sets of institutions and rules that guide fiscal policies and that allow countries to communicate on their fiscal strategy, to communicate both to the public, but also to financial markets and creditors. And to give a few examples, components of fiscal frameworks include whether specific debt or deficit objectives have been announced, whether they are independent institutions that monitor fiscal developments or they enforce some of the rules. But designing fiscal frameworks first requires determining a strategy. And so the first question we'll address in this presentation is, should the rise in debt be reversed? And if so, when? The second question we'll discuss is, what are the risks going forward, especially for debt? And the third question we'll address is, what are the features of these fiscal frameworks that are important to strengthen credibility? So to understand the strategy for debt, it's probably useful to have a quick look at the current fiscal situation. I'm showing here some densities across all the countries in our IMF database. And the left-hand side chart shows the density for debt and how it has moved since the global financial crisis. So of course, there's been a significant increase in debt that we know about. Now, this debt was increased recently because of higher deficits. And high deficits also contribute to gross financing needs, because these are the sums of deficits and rollover of existing debt. And the right-hand side chart shows how the increase in these gross financing needs has been quite important. And this is a source of vulnerability because countries have to finance these needs. Fortunately, the good thing happening at the same time is that debt has been relatively cheap, thanks to the global environment of low interest rates. And that's what the middle chart shows, with the interest bill, the interest expense divided by GDP, having barely changed since 2019. And actually, that's been true for all country groups, although it's there is an underlying trend, especially in low-income countries, of a higher interest expense. So since we've been talking about interest rates, let me stop a few minutes on this, because of course it's an important development in the question of the debt strategy. If interest expenses are lower than in the past, that levels higher than they were in the past can be sustained. And this raises two questions that I'm addressing in that slide and in the next one. The first question is whether indeed low interest rates have contributed to reducing debt. And when we looked at the empirical record, we actually found that low interest rates are not a silver bullet at the relevant policy horizon of, say, 5 to 10 years. In the right-hand side chart, countries displayed below the horizontal axis are the countries for which the interest rate was below the growth rate, and for those that would tend to decline naturally. But a lot of these countries we found are also above the 45-degree line that is in the gray area shaded here in the chart. And for these countries, it means that primary deficits were large enough that debt increased, even though it would have otherwise tend to decline thanks to the low interest rates. So that's the first question. Does it actually work in practice? The second question is whether we can indeed expect these low interest rates to stay where they are for some time. Interestingly, risk premia on government debt have been relatively stable since the onset of the pandemic, even though a few sovereign defaults have happened and several countries are under the scrutiny of markets. But in fact, when we regress risk premia on debt for a panel of countries, and we look at how the sensitivity changed a long time, we find that the sensitivity of spreads to debt has declined since 2017. And this is what the red line shows in the right-hand side chart. In the report, we know that it's quite possible that this is due to global factors, such as quantitative easing. And last year, there was also the exceptional increase in excess savings because consumption was restrained by mobility restrictions in the rich countries. And indeed, when we control for global factors in these regressions, we actually find that the sensitivity of risk premia to debt has mostly remained constant. That's the blue line. So relative rankings still matter. And the issue with these findings, I mean, the policy implication of this finding is that if there are global factors that may be temporary, maybe not well identified, we cannot assume that this effect is going to stay. So in particular, we know that tightening of monetary policies in advanced economies could raise appetite for risk, could reduce appetite for risk, sorry. Safe interest rates could also rise, which putting more pressure on financing needs. So all of this is to say that given the decline in the sensitivity of spreads to debt levels is not very well understood and is due possibly to global factors, there is no guarantee that it will last. So if we cannot count on low interest rates to ease the debt burden looking forward, then we do have to think through other policies, and in particular, fiscal consolidation efforts that would be needed to support reduction in debt levels and the rebuilding of fiscal buffers. Now, there are no obvious answers on the debt path forward. Macroeconomic theory does not provide a clear answer, or rather they provide different answers depending on the models being used. Empirical models have found that high debt is an issue, but there is no specific threshold above which debt reduces growth or increases the probability of crisis more dramatically, or whether this threshold is likely to depend on quite a lot of country-specific circumstances. In addition, the value of reducing debt now by some, let's say, 10 percentage point of GDP may not be very high. And we argue that it would also take quite some time. So in fact, the left-hand side chart shows some of our calculations that are very illustrative and that are not to be taken as a recommendation, just to gauge the extent of the fiscal consolidation effort that would be needed. So when we compare the primary balances that would be needed to bring back debt to 2019 debt levels, when we compare those to the average of primary balances that countries held during the period of 2010 to 2019, we find that they need primary balance maybe 0.5 to 1 percentage point of GDP higher for advanced economies and emerging markets. And this would have to last for, let's say, 20 years. So it's really a marathon, not a sprint. And this justifies the value of committing to reducing debt over a long horizon. In fact, because we were saying that the crisis is still ongoing, really reducing debt right now is not the priority at all. So it's maybe useful with a theoretical model to explain a bit the benefits of commitment. And this, the results are shown on the right-hand side chart. What we did was to run a theoretical model of sovereign debt risk and compare the solution when a country is able to commit to reducing deficits in the future versus the results when it reduces deficits now. So the first blue bar in the right-hand side chart shows that undertaking fiscal consolidation immediately does reduce spreads. That's the effect that it's intended, but it also comes at a cost for employment because the red dot shows a significant reduction in employment. Whereas when the country is able to commit to reducing debt in the future, spreads also fall. That's the blue bar on the right part of this chart. That's because the commitment allows the private creditors to trust that debt will be sustainable. And at the same time, employment is protected, and that's what the red dot being above the zero line shows. So it's actually helping the country fight the crisis. So of course, the practical question is, how can countries commit to being responsible in the future? One way is structural fiscal reforms, for instance, pension, subsidies reforms. These reforms could start when the recovery is underway and the political environment is ripe for them, and they reduce deficits durably. Governments can also pre-legislate changes to other taxes or spending. And finally, they can design fiscal frameworks that embed deficit reduction in the future and that are credible. So the bottom line is that for lenders to be willing to support for potentially a long time higher levels of debt, the credibility and resilience of fiscal plans is essential. This leads us to the second topic of our report, which is that there are also upside risks to debt going forward. Indeed, debt often jumps during and in the aftermath of crisis. And in this crisis that we're living through, there is still considerable uncertainty around the evolution of well, the pandemic and the economic recovery. Many countries have also taken risks with corporate support programs and implicit guarantees to state-owned enterprises. And finally, there are new risks looming like climate change, natural disasters. So it's important to quantify risk to debt. The chart on the right-hand side shows that over the last 25 years, unexpected jumps in debt have been large, around 15% of GDP. And that was especially true for low-income countries. This is the left-hand side part of that panel. So among the most important risk factors driving these debt jumps was disappointing economic growth. Its contribution is shown in the middle panel of this chart, and stock flow adjustments, which are on the right-hand side panel. Now, knowing this fiscal risk is important for the design of a fiscal strategy for several reasons. First, the fiscal objectives, such as the levels of debt or the levels of buffer, should take into account the risks going forward. That's important for the design of the debt strategy. The second reason is that institutional coverage of fiscal frameworks should also include sources of these risks. So for instance, if we have in mind in low-income countries, state-owned enterprises, it means that the fiscal institutions should look at the risk there and seek to control them. There are also practical questions in terms of policy making, such as budgeting. It's important that budgets include expected losses of programs that can create future liabilities, so that governments understand well the cost of their policies and how the different options compare. Finally, policymakers can also design risk mitigation policies. For instance, guarantee programs to corporates may have restrictions on the loan size, on the maturities, or on the credit class of the firms receiving support. The third question that I want to talk about is the features of the fiscal frameworks that help improve credibility. Now, these fiscal frameworks are now quite sophisticated. They include announcements of long-term fiscal objectives, procedural rules for how budgets should be prepared and executed. There are also medium-term budget frameworks in some countries. And numerical fiscal rules are also important in many places. Finally, reporting and external oversight is also part of what we talk about when we think about fiscal frameworks. So the problem is that the fiscal frameworks need to balance several objectives, not just reducing debt or satisfying fiscal sustainability. In addition to fiscal sustainability, there are also two additional objectives. Important stabilization of the economy is one of them, and simplicity, which is also essential for communication and for enforcement of fiscal frameworks and fiscal rules in particular. Now, satisfying these three objectives is not easy, which is why it is presented as a trilemma in the literature and in the chart on the right-hand side. And in fact, changing circumstances can also lead countries to choose different points in this trilemma. After the global financial crisis, countries realized that their fiscal rules were difficult to enforce and didn't allow for enough space to undertake fiscal expansion during a crisis. So this has led to what has been called a second generation of fiscal rules that put more emphasis on stabilization of the economy, and at the same time, these more sophisticated rules also came at a cost in terms of more complex rules and less control on debt. So the pandemic is one of these crises that has led to unprecedented fiscal response. In fact, many fiscal rules had to be suspended. And so it's one of the situations where many countries have to reconsider what to do with their fiscal rules, including whether to reactivate them or to adopt new rules. Maybe some redesign will be necessary, but it's important not to throw the baby with the bathwater. So some fiscal frameworks with numerical objectives have actually contributed to fiscal sustainability. The left-hand side chart shows that fiscal authorities constrained by debt rules are more likely to be prudent and to take measures to reduce debt after a shock that increased debt. These results are obtained from estimating what is called the fiscal reaction function that relates fiscal deficits to the history of debt, maybe, but also the variables such as the output gap. These regressions find that after an increase in debt, countries that follow debt rules tend to increase primary balances more than countries that do not follow debt rules. And similar results are found for countries that follow deficit rules. So fiscal rules seem to work as intended. However, they do not have to target debt necessarily. The left-hand side chart was focused on debt, but in fact, some economists, in particular Jason Furman, Larry Summers, have argued that pre-COVID debt objectives are too conservative now because interest rates are low. And in general, setting a fiscal objective of fiscal rule in terms of the interest bill could be appropriate because indeed the interest bill is a good measure of the burden of debt on budgets. And this proposal has advantages mostly in countries that are not exposed at all to rollover risk. But for the majority of countries that have to worry about rollover risks, the stock of debt is informative on fiscal vulnerability, and therefore can also be a good target variable. So I think it's a balancing out of which variables to look at, and it's in general useful to look at a variety of indicators. A related issue for emerging markets is also that the fiscal rule based on the interest bill could lead to more procyclical policy than a debt anchor. And that's what the right-hand side chart seeks to convey. It shows the interest bill in emerging markets is more sensitive to the cycle than the debt to GDP ratio for the emerging markets, so the light blue bars. You see the red dots tend to be more negative than the blue bars, which mean the interest bill tend to move more with the cycle than the debt to GDP ratio. This is just because effective interest rates on debt tend to increase in recessions for emerging markets, and the reverse tends to be true in advanced economies, where debt tend to fall during recessions. When we look at the second component of the trilemma, there are both old and new proposals for giving more flexibility to countries to manage economic cycles and crises. Procedural rules have also been proposed to move away from arbitrary numbers, and this can be effective in countries with strong fiscal transparency and oversight, and where there is a large constituency, for instance, in Parliament, that supports fiscal responsibility. Another option is to use expenditure rules. This constrains the growth of government spending, but allow for government revenues to move with the cycle. A new proposal has also been to allow for larger deficits when monetary space is constrained. Recalibrating rules with higher ceilings for debt or deficits in light of the low interest rates is also worth considering at the current juncture, but it's not clear what the impact on credibility would be. On one hand, revising a rule can improve credibility because trying to adhere to an unrealistic target increase the likelihood it will be violated. On the other hand, revising a target may also signal weak commitment to having fiscal targets. So the limited experience we have suggests that context and communication is key. For this report, we did an extensive analysis of the media reaction to the suspension of fiscal rules that happened last year, and that's what is shown in the right-hand side chart. What we found was that newspapers' reaction was actually quite positive in all countries. In most countries, the line 0 here really reflects how positive were the reporting. And we think that this is because the pandemic provided a good justification for suspending fiscal rules. Even then, countries with more transparent communication benefited from more positive reporting, which is what the slope in this chart is showing. Let us now look at the third objective of fiscal frameworks, which is to be sufficiently simple so that it helps communicate on fiscal policy and budgets. To check if fiscal rules matter, we first needed to build a measure of the credibility of budgets. And we did that by comparing official projections for the deficit as announced in budget documents with the private sector expectations from the deficit that we can collect from surveys like consensus forecast. And this natural measure of budget credibility, because its comparison between official announcement and the private sector expectation, is what we also use in monetary policy when we look at the credibility of the inflation objective of a central bank. Interestingly, we find that fiscal rules and the existence of fiscal institutions that help enforce fiscal rules indeed help improve this measure of credibility of budgets. So why do we care about this effect on credibility? Well, there are two immediate benefits, and these bring us back to my initial comments on the difficult trade-offs that fiscal policy is facing right now between, on one hand, supporting the populations during the recovery period, and on the other hand, preserving some fiscal space for future shocks. The first benefit of credibility is that predictability of fiscal policy is going to be important for the private sector. It helps provide some certainty on the economic outlook and thus can spur private investment and growth. And these, of course, would make the parameters that governments face much better. The second benefit is that credibility seems to pay off directly in terms of low interest rates and funding costs for government. We show in the left-hand side chart that there is a significant correlation between funding costs and the credibility of budgets, which is measured on the horizontal axis using the same measure that I was discussing before of comparing official and private forecasts for the deficit. More specifically, we can actually identify that these gains seem to be related to the communication of the budget, because in the right-hand side chart, when we compare sovereign yields around the time of budget announcement, we find that funding costs fall by around 40 basis points when budget announcements are credible, and that's not the case for low credibility announcements. So these are tangible benefits that will again improve the the fiscal situation governments are facing. To conclude, debt is high and creates risk, but even though fiscal consolidation might be needed at one point to reduce debt, it should wait until the recovery is in a strong footing. Fortunately, we think strong fiscal frameworks can buy time to policymakers, because by making fiscal policy more credible, that can ease financing and improve the growth outlook. The choice of the fiscal framework, for instance, the fiscal anchor or the fiscal rule, is really country and period specific. So that's, there's going to be a lot of reflection to be done for each country. At the same time, we want to mention that numerical rules have worked as intended. So there are some advantages of keeping in mind the numerical objectives, even though it's important to also think about the other objectives of fiscal frameworks that are stabilization and simplicity. Reforming fiscal frameworks will be more successful if the flexibility is provided to accommodate the conjunctural situation, which is still very difficult in many places. Of course, political consensus and fiscal transparency are also important. So thank you very much for your attention.
Thank you, Raphael. That was terrific, and I want to say again, how terrific I think this chapter is. I know I get lots of questions these days about what more countries can do to mitigate the effects of the pandemic and the economic fallout from the pandemic, and those questions are just so hard to answer if the starting point is we have no fiscal space. So I just think this study will be just like a great reference to point people to about how maybe to create a little more fiscal space. We're getting questions on Q&A. So please, if you have questions, feel free to answer them, and I will ask them of our panelists. I'm going to start you off with a very, very basic question, but it's a question that I feel like I get all the time, which is kind of what the optimal level, as countries are thinking about what they should commit to, what the optimal level of debt is. And if your answer is we can't really, say because it depends, what do you then say to a country that wants to know about how to think about it? How should they, if there is no magic number, how should they think about it?
Thank you, Karen. Maybe I will start the conversation on this one, and then of course Raphael can complement as needed. But first, let me thank Peterson Institute for inviting us. It's really a pleasure to be back, and I'm really thrilled to see the energy with which Ted Truman is already participating in the Q&A. I mean, it just brings good memories of lively debates. To your question, I think that the way we look at it is a very practical way. And essentially, countries are where they are right now. They're starting out with higher debt. In some cases, it's much higher than before. In other cases, it's gone up a little bit, but it's only gone up a little bit because countries were already constrained in the access they had to financing. And as you mentioned, very early on in the crisis, the message that we came up with was spend what you must, but keep the receipts. And indeed, we really are very supportive of the fact that countries provided very large amounts to their people, to their firms, to make sure that they could survive the early part of the pandemic, and they were able to provide support to the health system, which was the priority. So looking forward, it really depends on some basic aspects of what countries are facing. The first is the stage of the pandemic and the stage of the economic recovery. Obviously, for us living in the United States, we're beginning to see the light at the end of the tunnel, but that's not the case for many other countries where the pandemic is still raging. So in many countries around the world, it is still the priority, the absolute priority to face the health emergency. And so that should remain the main consideration driving public policies. Then comes the issue of access to financing and the cost of borrowing. For countries that have ample access to financing, maybe they can be a little bit more relaxed in terms of continuing to provide very generous support, whereas in other countries that don't have that luxury, unfortunately, very difficult choices are having to be made between providing support for COVID-related items, but what we see is that in some cases, countries are already cutting on public investment or even other types of priority spending, including spending on healthcare, but in non-COVID related items. So the situation differs depending on those. And perhaps more recently, there's also the fact that in some countries we see very significant inflationary pressures. So that also should be at the back of the minds of policymakers as they make these difficult choices. As Raphael pointed out during the presentation, if countries hypothetically wanted to go back to the pre-pandemic debt levels, that would already take maybe 20 years of higher than pre-COVID primary surpluses. So that just gives us a sense of the fact that debts are going to be elevated for a while, for decades possibly, and it is going to be a long, drawn-out process of gradual stabilization to first stabilize the debt and then to start recreating that space that we may need to deploy for the next big shock that we don't know what it is going to be, but we know it will happen at some point. So that's a very long way of saying there's no magic number, but those would be the criteria that would guide the setting of a target in the next few years. And I'm happy to elaborate. I'm sure Raphael can come back, but maybe I should go quiet now. Thanks.
Well, let me just one further thing, given how you answered that question. So yes, it was a hypothetical exercise of what countries would need to do if they wanted to go back to pre-pandemic levels of debt. And when you when I saw that in the study, it made sense to me in a way, because, well, we think interest rates will rise, as they typically do coming out of a weak period in the economy. And the normalization of the economy and the normalization of policy. And so then maybe interest rates will go back to where they were pre-pandemic, which is higher than they are today, but nonetheless much lower than they were, or at least the global safe rate than they were in the early 1990s. And I think you hint at, well, maybe we shouldn't kind of count on that being true. And I guess I just wanted to push you a little harder on that one. We think the decline in global safe rates has been related to a set of slow-moving, longer-term factors that have basically changed the supply and demand for loanable funds. But I want to know kind of what should we be watching? I mean, obviously for kind of riskier countries, it's going to be the risk premium that could take the interest rate higher than it was pre-pandemic. But what about for the rest of the world? Kind of what factors might, why should we be worried that interest rates might end up being even higher than they were pre-pandemic?
Thanks. Let me say a few words and then invite Raphael to come in. Perhaps Raphael, you could say a little bit about our findings on relative debt versus absolute debt. But in the meantime, let me say a few words about the issue of whether interest rates might go back up. So absolutely, the central expectation is that global rates will remain low for long. Here I'm talking about real rates. We've already seen some surprises in inflation, and of course we need to keep watching that. I would point out that if you go back to Olivier Blanchard's very influential study a few years ago, he found that the very famous R minus G has been negative on average in the United States. And if you broaden that sample to include all countries for many, many years, which we've done, what you find is that indeed R minus G is very frequently negative, and perhaps even more so in the case of emerging markets. And exactly at the same time, even though that's the case, we still see defaults in the global economy, and it's a frequent occurrence, particularly among emerging markets, but not only. And so I would say on the likelihood that interest rates all of a sudden surprise on the upside, that's a very frequent phenomenon for developing countries, emerging markets. So you might think that R minus G is very favorable, and then all of a sudden there is a kind of unexpected jump in interest rates. And we've documented that very clearly. It happens, and it's something that we need to be very mindful of. And likewise, we've documented that even though the predictive power of fiscal variables for debt crisis is not fantastic, there is some predictive power of debt to GDP for debt crises and defaults. For global rates, I think that indeed, I'm not going to bet on any particular evolution over the next few years. But what I will say is that what really matters is what's going to happen to rates over the next 10, 20 years. And so just like, we've been surprised on the inflation side. Who knows? We might be surprised on that side as well. It's harder to really cook up scenarios on exactly what might trigger an increase in real rates, but it's not something that we should discount. And the most important point is that, as the charts showed, the evolution of debt ratios is not just driven by interest rates. It's much more importantly driven by growth, economic growth. That's number one. And number two is the primary deficits. And if countries have an aging profile that tends to make their debt ratio increase in the next 20 years, that is going to be very relevant regardless of what breathing room we're getting from interest rates. I'm going to stop there. Thanks.
Thanks. Okay. Yeah, so let me turn to some of the Q&A that are coming in. So yes, you mentioned that you had noticed that Ted Truman was already chiming in, and he is in the Q&A box. But Ted and others are pushing you harder on the risks around rising debt, and you've already mentioned the risks of defaults and crises. But can you speak kind of more generally? Some of the questions I'm getting are, who really cares about debt? You showed a chart, and the chart had shaded areas where some countries were in the kind of danger zone in terms of RNG. But what about the others? We certainly have seen kind of the United States, the European Union, big increases in debt, putting it towards, certainly during the pandemic, what seemed to be very good uses, and even outside pandemic, arguably good uses. Can you just expound more on why we should care beyond the risk of kind of maybe it'll lead to a crisis?
Sure. Maybe Raphael, why don't you come in, and then I'll say something afterwards. Thanks.
I first want to mention that, when we talk about the dangers of debt, we're covering a broad range of countries, and not all countries are equally exposed here. So if we talk about the US, Europe, the cost of debt in these countries typically does not come from risk with the financing and crisis the way you would have in countries that are borrowing in foreign currency, that do not have deep markets and a deep pool of lenders. I think for advanced economies, the risks, the costs from debt tend to come more from the restriction that high debt tends to pose on future reaction to crisis. So it's been found in the literature that countries that have been worrying about their debt level tend to do less in future crises. Maybe this is because politicians even are worried about the signal they are sending. And I completely understand the argument that we shouldn't be worried about an accounting number if the only thing that matters is the interest expense, which is, I think, one of the message of Froman and Summers. If the only meaningful variable is the interest expense over GDP, then the accounting value of debt is not really very relevant. The point is that this might be true in some countries, but in many other countries, the need to refinance debt, to go to markets, to reborrow, to roll over the existing software debt are significant risks. And these do imply that a measure like debt to GDP is a reasonably good variable to proxy. Now, since Paolo was mentioning the exercise we've done with regressing risk premia to debt ratios, we find this result, right, even for emerging markets, that the current environment has been relatively mild for them, despite all the jumps in debt and deficit and gross financing needs. The global environment has been relatively mild, and you find that when you do regressions of risk premium on debt, where you see this elasticity is coming down. What we want to show in the exercise is that when we do relative rankings of countries, we still find actually that markets are differentiating countries with relatively high debt from countries with relatively low debt. Now, why does it matter, the differentiation? Is because all countries maybe at one point shifting together as well, right? If countries are still conscious about the level of, if markets are still conscious about the level of debt, at least relative to each other, it means that they're looking at these variables still. And the fact that the global sensitivity has fallen might just be a reflection of some global factors that could reverse. So I think that's one aspect. And finally, relative rankings matter. So countries still do well compared to their peers.
Thank you. This is I think a somewhat related question, which is, does your research cover the implications for growth of better performance on fiscal rules? So do you actually try to kind of quantify this kind of better performance and what it implies for growth, and how if you do, how expansive is that analysis? Do you, for example, would it, for example, take into account kind of the greater space a country is going to have in a future crisis to respond effectively?
Thanks. So in this particular study, we didn't focus on the impact or the correlation with economic growth, which is unfortunately always, there's a very large literature on economic growth where many variables matter, but not very robustly. And I think that's a literature that we haven't gone back to this time. But what we have done with a lot of care is to look at the correlations with the cost of borrowing. And so I would certainly ask Raphael to go over some of those results in detail. But again, we have evidence that there is some advantage in terms of lower cost of borrowing for countries that have fiscal frameworks that are associated with credibility, and that in terms pays off in terms of a few basis points. We're not talking about massive impact, but it's clearly something that is macroeconomically relevant and that policymakers do care about. I did want to mention again a couple of points on are we being too hawkish? I just want to reiterate that we do view the rise in debts that has taken place as being fully justified and fully appropriate. And we're not saying, slam on the brakes and immediately go back to low debts because the danger is major. That's not what we're saying. We're just reminding ourselves as economists that that there are limits to how credibility can be stretched, and so it's really just thinking about how over the next decades we are going to give a signal that that is under control. It is something which is extremely different across countries. So in the case of the United States, for example, it's pretty easy to borrow at low cost. And traditionally, there's all of the discussion about exorbitant privilege. And so from this country's perspective, it may be hard to think about, the constraints on debt, but we have maybe about 50 countries that are currently either in debt distress or at high risk of debt distress. Many countries are unable to borrow at this very moment. And even for advanced economies, it's only a few years ago that we had very high bond spreads in several European countries, including one of the G7. So it's not something that should be discarded as a concern. And even for countries like the United States that are at the very core of the global financial system, the probability of a rollover crisis is, of course, extremely low. But it's important that we maintain that credibility because if that were lost, then the consequences for the global financial system could be devastating. So, it's something that needs to be preserved over the next decades. The other thing I would say is we have a very interesting exercise in the Fiscal Monitor on how people perceived, particularly the media, perceived the abandonment of escape clauses. And what we did is we looked at the words that were used by the media in articles that talked about the announcement of when a escape clause was called. And so for France, the articles would say, well, there's a pandemic and health emergency and virus. Those were the words that were coming up in the articles that refer to the fact that the escape clause had been called in Europe. If you looked at the articles for even relatively sort of sophisticated emerging markets like Colombia, there the words were credibility, fiscal rule. So the emphasis in the media was immediately not so much on the reason, the very well justified reason that had caused the temporary escape from the rule, but rather it was on the issue of credibility. When are we going to go back to the rule? And so the perception by markets is something that is perhaps very hard to explain, but it is really what makes all the difference in terms of how much leeway countries have in terms of their debt targets and how quickly they have to go back to them. Thanks.
Thank you. And I thought the media announcement was really interesting. And so I do have a question that is on the kind of the analysis you showed after that one, which was the market reaction. And I think this is just a kind of a technical question, which is, should the impact of announcements on yields depend on whether the announcement is a positive or negative surprise?
Yeah, so I had the same question actually, and Raphael convinced me that the right thing to do was to look at all announcements. But what I can say is that even when we look at only positive announcements, the main results hold. Raphael, why don't you come in and explain a little bit more about that exercise, please?
Yes, I think the point is to more focus on credibility itself than whether you're tightening deficits or whether you're loosening them, right? And so that's why we did the exercise for the whole sample. But when we did split the exercise, we found that indeed the results even hold when deficits are widening. And that's because it's important, if your deficits are widening, that you're also credible, that you're not going to give even further than what you're announcing. So that's the first point. The second point I want to mention is that when we looked at how private forecasters assess official announcements, they don't necessarily give more credit to bigger efforts at fiscal consolidation. In fact, they tend to discount more than half of any announcement. So if I announce I'm going to do a 4 percentage point consolidation next year, they will give you 1.5 point of consolidation in their deficit. So that means that in any case, there is always a bit of I would say hysteresis in how private forecasters look at deficits, and so a bigger announcement is not necessarily something that pays off, neither in terms of the forecast nor in terms of the market interest rate.
Thank you. And say again how you measure credibility.
Yeah, so we do it by comparing the official announcement in the budget documents and sometime in the budget updates for the deficit of next year, and we compare it to the consensus forecast number for the deficit of next year as well, the private. And this gap, and we always calculate the gap as a difference between the official and the private sector, because typically the official tend to be more optimistic than the private sector. And so this gap is a gap, and this gap tends to be, I forgot if something around 2.5 or something. And then as we add fiscal rules in one of the bar chart I was showing, as we add, when we look at countries with more fiscal rules and more strict monitoring and enforcement of these fiscal rules, we tend to find this gap kind of shrinks because the announcement is closer to what the private sector projects as well.
Yeah, thank you. Yeah, that just seemed like such an interesting thing. And were you able to do it for, how big was your sample? Were you able to do this for all countries, measure credibility, or was it just restricted to some?
No, I think we have 35-ish countries that include Europe, Latin America, some of the G7. So it's quite a big sample of advanced economies and some emerging markets.
In some origin, okay, but you were not able to, because I was going to ask you about heterogeneity, but it sounds like your sample was restricted. You've already mentioned the highlights, which is difference across the emerging markets and the advanced economies.
Yeah, I think we have 34 countries, but a lot of them are advanced, but not all. We do have quite a few emerging markets.
We have lots of questions coming in. Unfortunately, we only have time for one more. I'm going to bring you back to something you mentioned earlier, Paolo, which was the important issue of population aging, which is happening around the world. And it is over the next few decades going to challenge so many countries because they're going to have to provide income support for their older populations, and they're going to have to provide healthcare for a population that's not only kind of passing retirement age, but just kind of getting older and older, and therefore requiring more expenses. So I wanted to, this may be more of a political economy question, which is just, given my focus in the United States, I know that, everyone seems to know that we need to fix this situation now. That would be the optimal thing to do, to give people and institutions time to kind of get ready for whatever changes we make in the system that provides these benefits. But I just was curious, based on that experience, how many countries have, in fact, or do you have a sense how many countries have addressed this problem that kind of everyone knows is coming? And really should be addressed now. And if it's not many countries, what does that say about kind of how optimistic we should be about them making even more expansive commitments to sustainability?
So, well, let me probably broaden your question even further. I mean, for all countries, there are major needs for investment, be it in physical investment or human capital investment, which would include healthcare. And so for the advanced economies, many face aging. Of course, some emerging markets, including very large emerging markets like China, there is already a prospect of aging that is for sure happening. But for the younger economies, India or sub-Saharan Africa, you have a similar long-run challenge, which is to finance more physical investment and education and widening coverage of healthcare as well. So all countries have these long-run challenges that pose pressures on the fiscal. And kind of that's why we think it's important to do these medium-term fiscal frameworks that give a sense that while you're addressing short-run emergencies, you're also thinking about how to take care of the need for reforms going forward. There are many countries, coming back to your question on aging, there are many countries that have made important reforms on pensions. and health as well. Of course, the differences in the health care system between the US and the rest of the advanced economies are extremely pronounced, and that's worth a whole book. I certainly recommend Case and Deaton as something that I think resonates in terms of the need to cover more people. The one thing that I will say, which relates to the pandemic, is that, and this is on a US sample, but I'm wondering whether that has more general applicability, is that we looked at, we know inequality went up in many countries during the pandemic, most countries. We also know that it exposed differences in the healthcare protection across individuals. And what we argued in the previous fiscal monitor is that in order to finance the needs for public services going forward, it's appropriate to start thinking about progressive taxation. And again, the reason is that inequality has gone up so much as a result of the pandemic. When we did a survey on a sample of US residents, what we found is that people who were personally affected by the pandemic, either through illness of a family member or job loss, those people were more likely to be in favor of progressive taxation. And the shift in their preferences was even more pronounced for people who have moral values that are of a communitarian rather than universalist kind. So in the United States, it might be that people who have more conservative attitudes were more likely to make the switch than people who have more kind of liberal attitudes. So the point I'm coming to is that, yes, countries have made reforms, and perhaps the pandemic is going to change attitudes in the direction that is likely to give more prominence to the need to reform healthcare and to look at the long run as well. But again, this is a hypothetical based on a limited survey.
Well, thank you. I like ending on your hopeful note. So yeah, we're out of time, but I want to thank Paolo and Raphael for coming and talking about the study, and also answering our questions. And I want to thank people for attending. I think this chapter is a really interesting chapter. For those of you who haven't read it, I recommend you do so. You can find the link to the study right in your event invitation. So again, Paolo and Raphael, thank you so much. And I hope you'll come back again sometime and tell us about your future studies.
Thank you very much.
Thank you very much, Karen.